What do you need to commit to? Because there's some things you need to commit to not doing to then ultimately exit.
They've compromised their future at their client's behalf because they don't have the money that they need to retire. So they're looking to take that check instead of maybe take that next best step for their clients.
Be intentional and be methodical and give yourself the time to be able to actually go through those steps, because that's what's going to guarantee the best outcome for your clients, for your staff, and then ultimately for you and your family.
Welcome to the Total Succession Show. I'm your host, Tyson Ray, joined by Kim Kokenauer. We're glad you're here. Subscribe at totalsuccession.com/podcast and let each episode guide you closer to a confident, well-planned exit. Today's conversation just might be the nudge you need to start preparing for what's next.
Hi, everyone, and welcome back to the Total Succession podcast. On today's episode, we are joined by Nate Lenz, the co-founder and CEO of Concurrent. What we really like about Concurrent is that they've made independence sustainable for advisors. You get scale, tech, and the backing, plus a structure that actually helps you in succession.
And we're excited to have Nate on the Total Succession podcast because he's got a succession background. And so, Nate, thanks for coming on.
No, it's great to be here, Tyson, and thank you for the intro, Kim. I like the sustainability aspect. That's a great. I might have to steal that from you as I describe our value prop going forward, because I think that is absolutely a key element to it.
Yeah, you bet. And you're welcome. So we're glad to have you. So I think independence and succession are kind of finding a whole new lane right now as we're kind of seeing this transition in our industry. And so it's been really interesting to watch, but I'd love to kind of hear your take on that.
Well, it's come a long way. And as Tyson mentioned, I have a succession background. So I actually started in the wealth management space, working in the succession and acquisitions group at Raymond James. So cut my teeth there, ended up leading that team from 2013 to 2016, prior to breaking away and going independent myself, so to speak. But it was really interesting to see the progression, right, of how succession planning has been done. You go back to, call it 2011, 2012, that time frame, pretty much every deal was, 2 times recurring revenue, 1 times non-recurring, 35% broker-dealer financing on a 5-year term, and the rest on a 5-year earnout. And that was every deal, right? Then all of a sudden you saw, the entrance of like a Live Oak Bank, right? S.P.A.C.E financing into this space. And now you could go get debt on a 10-year term, which that helped support higher valuation multiples, right? And you saw a higher percentage of cash at closing in transactions and things like that. So there's quite an evolution there. And then, enter over the last 5 or so years, private equity, right? And I think it's been interesting to see how the space has evolved, how valuation has evolved in the space. And I don't think it's all been for the better in a lot of ways. And we can maybe talk a little bit about that, but it's definitely been quite the evolution over time. And, as we think about our business model, we've kind of grown up alongside of it. So as I mentioned, I left Raymond James in 2016. I didn't leave to start Concurrent. I actually started an M&A consultancy called INA Consulting, Inspire and Acquire. And really my mandate was working with firms primarily on the buy side, looking to grow through strategic acquisition and recruiting, and looking to build a model where I could come alongside of them as their outsourced business development M&A team. And what we found about 6 months into that venture is that a lot of my clients, while they had some scale, really what they would need to be effective in really building a business that's fueled through recruiting and acquisition in a repeatable manner would have been cost prohibitive. And so that ultimately led us down the road of bringing together the original founding group of firms, facilitating a merger and launching what would later become Concurrent. So, it's definitely, I think we've had the opportunity to see the industry evolve as we've evolved. And we think we've met a great point in time where there's now a convergence where I think we've got a really great solution.
I want to hit on what's the downside of all this, because everybody gets so excited about bigger checks, but or bigger multiples and all this other stuff. But I'm interested to pull your insights on some of the downsides.
Yeah, look, I think at the end of the day, we have a very healthy market. I think the capital markets in a lot of ways have been educated on the value of wealth management businesses, right? Because at the core, these businesses spin off a ton of cash flow, right? They're biased to grow with the market. And so you have this really unique combination of yield and growth, which I think is why this has become such an attractive place to invest. So that's why you've seen the influx of capital that you have. So I don't think that's necessarily a bad thing in and of itself. Where I do think there are some negative consequences to it, is when you start to look at what it means for the next generation. I think that's where, you've got this almost confluence of issues where our industry as a whole has a colossal lack of patience with the next generation in terms of being able to allow them to develop and learn in the space. There's always this expectation of, I'm going to bring them
Yeah.
in and I got to start producing from day one, right? And it's just, you've got a lot of folks that come in with a high degree of competency, don't have quite the sales acumen yet to do it. And if you're held to too high of a standard in that regard, I think you're losing the utility that they can bring to the table and helping you really expand your scope of services and deliver a world-class client experience. So I think lack of patience is one. Just the lack of new entrants coming into the space, right, is a problem. I know that McKinsey study that came out earlier this year cited we have 100,000 advisor shortage by 2034. Now, I don't necessarily subscribe to that philosophy per se, because I think there's a lot that technology is going to be able to do to ultimately help us become more efficient and allow advisors to serve more clients. But I think directionally, it's correct in that you've got this rising demand for advice and a falling supply of advisors, right? So
Yeah.
I think directionally that's absolutely correct. Well, all of a sudden, when you start to look at like the entrance of the private equity backed roll ups into the space, right? And I think that they can provide a great solution for an advisor who is looking for succession or has hit a plateau. um, I like to refer to them sometimes as white flag businesses, right? Where they've said, okay, hey, look, I'm okay with putting on the fatigues and saluting the flag because it's going to allow me to monetize my business. And frankly, in a lot of cases, I think those roll ups can provide a heightened level of client service and support and better resources. So I don't think it's necessarily a bad thing in and of itself. But all of a sudden, when you've got businesses where they have multiple generations in place, and let's say that those junior advisors, right, or G2 are equipped to serve clients and take over the business, we've seen too many times where they go to bed on Friday, the heir apparent, and they wake up on Monday an employee of pick your roll up, right?
Mhm.
And so, and you look at the reasons why. We kind of went through that progression of how succession planning has evolved and how multiples have evolved. Well, all of a sudden, if you've got these private equity backed roll ups paying, call it 8 to 11 times EBITDA, right? And a portion of that's cash, a portion of it's stock. And you look at where interest rates have gone to, and you look at the prevailing financing terms, the problem is those G2 advisors can't afford to pay
Can't
the
do
same
that.
multiples as the private equity backed aggregators.
Yep.
So those sellers, right, have a decision to make. Is it maximize dollars in their pocket, or is it ultimately finding the best solution for their clients, right? Sometimes those can be one and the same, but I
Mhm.
think in far too many cases, you're seeing that that's not the case. And it's really, I think, putting that G2 advisor in a negative situation. So I think that's one of the biggest pitfalls of what we're currently seeing happening in the space.
Yeah. Well, and something we've even seen is that the advisor retiring has done a poor job of planning for their own exit, but often they've even done a poor job of planning for their own retirement. They've not been a good steward of what they've earned over the years. They've spent everything that they've made. And so at the end of the day, they've compromised their future at their client's behalf because they don't have the money that they need to retire. So they're looking to take that check instead of maybe take that next best step for their client. So that's I think we're seeing that, conflict of interest really as well.
Yeah. It's the cobbler whose kid has no shoes, right? Is like the story of our industry in some cases.
Yeah.
So no doubt, Cam, I think that's 100% right. I think you've seen that living outside their means, and they're forced to, ultimately sell to the highest bidder, but it can be at the detriment to their existing team and more importantly to their clients.
Yeah. What's it going to look like for those clients when they run into them at the grocery store? We say it all the time. If you don't plan your succession, you're planning the end. And so it's your lack of decision already is already hurting you before you even get there. So it's kind of interesting how that evolution's really kind of made that even more apparent now that those multiples have gone so high.
Absolutely.
Yeah, I just met an advisor at a fundraiser that had found out that we were in the same business, but he had just sold the practice to, everything changed. And the one thing that he was bothered by the most was the stress that he got the multiple he wanted, but he didn't realize the stress that now comes that you have to make these growth targets, right? Where you were retired, you were making the income, or not retired, you had the quality of life, you got to kind of just help people to help people. But now you got to grow at 10 or 15% a year for 3, 4, 5 years to get these other millions of dollars. And he just is like, I just have stress I just didn't have before. Uh, because he wanted a bigger number when maybe that wasn't what was best.
Yeah, it's interesting. I love the old adage. It's like, you tell me the number, I'll tell you the terms, right?
Yeah.
So I think that's I think at the end of the day, you're right. I mean, it's you got to be the devil's in the details with any of these transactions, and you've got to understand what you're stepping into. So whether it's earnout provisions, right, that are in place, or and look, I think there's even the level to which you're integrating with the acquirer is important. And look, there's all different flavors out there. I call it like the scale from like zero to creative planning, and there's kind of everything in between of levels of integration that you might face post transaction. But I think it's really important to understand, what those are, what that impact will be to clients. Understanding the financial terms is of utmost importance. In a lot of those deals, while the headline number might be extremely high, let's say a portion of that is in equity, right? It's important to even understand like what's the exchange rate at which you're receiving that equity. Because if that firm recently recapped at 20 times, they're valuing their stock at 20 and they're valuing you at 8 to 10, there's pretty significant multiple arbitrage at play as well. So I think it's really just fully understanding it. Now look, the multiples are drifting up for a reason because these are legitimately higher priced deals, right? So it's going to put pressure on the market. But you're 100% right, Tyson. Like you have to really understand what all those different components are and what's going to be required of you to fulfill those.
Cash in the stock, right? So you got these cash stock parts and you got the tranches into the future, your earnouts. And you got to remember, if you're listening to this, if you're looking at these deals, okay, a year from now, 24 months from now, 36 months from now, you're going to get this other 30% of the stock, but it's going to be at the value of that stock 3 years from now, not what it is today.
Exactly. And I think a lot of those deals, right, those firms are growing at extremely fast clips. So if they're looking at their relative growth rate to your individual practice over that time frame, right, that spread is even widening in terms of that valuation differential. So 100% correct. I think it's important to really, again, understand all of the different elements that are at play in getting you to that high headline number.
Yeah. Yeah.
So you touched on it. So let's talk about that next gen and successors and how that's needed. When they're coming to you with Concurrent, what's the advantage of having that next gen team versus basically you're yourself and a registered assistant or 2 or 3 people that are all looking at the door of retirement? How does Concurrent look at that?
Yeah, I mean, I think from our perspective, and it's no surprise, right? I'm in my mid 30s here, so I've got a long runway ahead of me. So thinking about the long term sustainability of our business is extremely important, right? So one of the things that we talk a lot about internally is succession readiness and understanding, what our teams are looking to do. At the end of the day, every team that affiliates with us, they're entrepreneurs, they're independent, they're running their own business, right? The core part of our value proposition is we're there to operate as the middle and back office, right? We're the platform that they're running on. We want to give them the benefit of our scale, our resources, our pricing power, our service power, so that they can operate in the fully independent, multi-custody, RIA space. But at the end of the day, not have to reinvent the wheel in terms of those core processes that are table stakes, right? And so from a platform perspective, we view our best opportunity to serve the end client as serving the advisor. In doing so, we got to make sure that there's, again, long-term sustainability in that advisor's practice, right?
Yeah.
Because I think, and Kim, you had kind of alluded to this, if they're not planning well in advance, right? Not only are they limiting their options, but they're putting their clients at risk of who's going to ultimately serve them over the long term. So that's something from the day they show up here, right? We're working on things like catastrophic planning and making sure that at least we've got the safety net in place if something unforeseen is to happen. From
Mhm.
there, it's understanding what their ideal timeline is, what their ideal approach is. Like, let's say that they are, and I started out a number of our like study group meetings and conferences last year. I would start out with an exercise of all right, where do you want to be, personally, professionally in 10 years? And you probably wouldn't be surprised to hear that a lot of the answers weren't, I want to be at 1 billion in assets and I want to do this. The answers were, I want to be living full time in Japan. I want to be teaching a college class, right? I want to be paying it forward to the next generation. So it's like, okay, so we're identifying that we want to be potentially doing something beyond operating these businesses at that point in the future. What do we need to do, over the next 1, 3, 5 years to start to put yourself in a position to be able to accomplish that? right? Not just financially, but more importantly, from a continuity standpoint, and just making sure that those clients are going to be taken care of and that you've put the right people in place to be able to take the baton. So for us, it's, and what that usually amounts to is, okay, if you're going to start to, if you either have people in your team or you're going to start to bring people into your team, then we need to be thinking about things like defining roles and responsibilities, compensation structures, career pathing, right? Creating paths to equity ownership, and making sure that you've got alignment within the business. That's, I'm a big believer that equity should be bought, not given, right? So, because you want to set that precedent, it doesn't mean it can't be done in an accommodative manner. But a lot of the work that we do is coming alongside of firms to help them both identify that path and then work through that path. And it's not completely altruistic in nature, right?
Mhm.
The other part of our business, in addition to being a platform, is we are a minority investor in the firms that choose to participate in our partnership model.
Yep.
So in most cases, we own equity in those businesses as well. So it's in our best interest to make sure that that those businesses are durable and sustainable. But what we found is it all starts with the people, and if
Mhm.
we can help them identify, what their preferred approach and timeline would be, and then help them start to work towards that by, attracting, developing, retaining, and incentivizing their people, that we're setting them up for success and being able to hit that timeline and accomplish that end goal that in most cases is well beyond just being a practitioner.
Yeah. Well, that's hugely helpful, Nate, because I think the talent that's coming out into the industry now, they see the advisor in their 50s, 60s, and 70s and see, gee, wouldn't that be nice if I could have that life someday? I could have that compensation someday. And they're, like you said, they're in their early 20s and there's a lot of runway to get them there. And maybe that 50, 60, 70-year-old advisor doesn't have the know-how or, they pave their own path. They're probably not geared towards creating that path and laying that out for them because the path that got them where they are is not going to be the path that takes that G2 into that next space. So it's wise that you guys kind of put some of that structure in place instead of making that founder come up with that structure on their own.
Absolutely. And I think it's an expectation setting exercise on both sides too. Cause like you said, I think you see a lot of folks that come into the business, they like the perceived work-life balance of it, right? They see the high income. We talked about unique combination of growth and yield, right, in these businesses. And so I do think, one of the things that the next generation of advisors, the perception that they're continuously going to battle, but in some cases it's rightfully so, is this entitlement mindset, right?
Mm,
Of I should be able
mhm.
to walk in and take over. I think when you look at these businesses and just to look at it kind of in the context of a P&L, right? You've got, 100% gross revenue comes in top line, then they're paying for, platform, custody, expenses, right? As that kind of next piece. After that, you get to the earnings before owner's compensation line item, right? The difference between, that number and what we'd call like an EBITDA number is advisor compensation, right? That's the compensation for sitting in the seat and doing the job. I think the problem is you have a lot of these G2 advisors that look at that EBOC number and assume that that's the compensation for sitting in the seat and doing the job.
Yeah.
The reality is the majority of that is the compensation for taking the risk of launching that business and building that business, right?
Mm,
And so I do think there's an expectation setting piece, but if you do it properly and you again are setting your compensation structure within the boundaries of that advisor comp kind of target, but then from there, you're showing them a path where if you hit certain growth milestones, you'll have the opportunity to buy in equity ownership in an accommodative way. So all of a sudden now they're seeing a path to participate in both. I think it goes a long way to setting the expectation that there's an element there for risk, right? And for the build, and there's an element there for doing the job. And you don't want to conflate the two.
Yeah, too many advisors are still thinking that, they need to hire the rainmaker, or the one that's gonna go do 3,000 cold calls in a month, right? And it's just not the way the business is done anymore. Um, and yet, we're still a referral business and just great client service. That what I found is the Gen 2s that we have, because they are used to this technology and they're freed up and they're not having to do sales necessarily. They're zipping back the emails, they're returning the phone calls, they're giving high levels of service, which generates referrals, which generates these things. And so it's just to think differently about how the business has evolved from the sales days that many of these advisors that are looking to retire in the next 5 to 10 years grew up in.
Exactly. Exactly. I think you have this dynamic where, in a lot of cases, individuals, these advisors feel like they need to replicate themselves, right? In
Mhm.
reality, in many cases, it's probably going to be done by committee, or it could be done by, a combination of potential G2s paired with platform resources and outsourced resources.
Yep.
There's a lot of ways to get there, but I agree 100%, Tyson. Likely not their clone, 30 years younger. It's likely going to be a different animal because clients are expecting, like to your point, the elevated service levels or broader scope of services that are being delivered. And, being able to go build kind of specialization within the practice and having multiple touch points ensures, balls don't get dropped. There's accountability, but that you're able to deliver that broader and deeper solution set. And that's what clients are coming to expect. And I think that much better fits the talent pool that's now coming in.
Yeah. We say often on here, you don't need to hire your clone, you need to hire your complement. You need someone who's going to kind of fill those gaps and kind of take that next level. And it's not going to be just like, they're not going to be just like you. Well, and because there's kind of that war on talent out there and kind of what you're seeing in the next gen talent pool, I'd love to kind of pick your brain a little bit. Are they really, from a retention standpoint, are they looking more for ownership opportunities? Are they drawn in more for culture? Is it all just on compensation? What are you kind of hearing from your team there?
Yeah, it's interesting. I was actually part of a focus group a couple of months back, and there was a survey that was done by FinServe that was looking at a pool of kind of recent graduates that had entered the wealth management space and was looking at some of the motivations for what they're either looking for in a firm or why they landed at the firm that they landed at. And surprisingly, things like work life balance, remote work was at the bottom right of the survey. Like that was not what they were primarily concerned about. Compensation was really kind of in the middle, it wasn't at the top. What was at the top were opportunities for advancement or mentorship and development, right? That's what really they were looking for. I thought one of the other things that was in that survey also was like, where do you see yourself in 10 years? And I think it was something like, it was a majority of the respondents said, owning my own firm or being a partner in a firm. Those were like the 2 top answers, right? So I do
Wow.
think you have this, kind of, generation of entrepreneurs, right? It might be spawned by this gig economy we're seeing and this kind of, I think you've even seen almost the pendulum swing away from kind of the large firm mentality coming out of the financial crisis. So it's an interesting time. But I thought that, again, these young advisors that are coming in looking for mentorship, looking for development. So it's not necessarily about the comp, it's not necessarily about the firm or the brand recognition. And I think if you start to think about where they want to be in, 5, 10, 15 years, recognizing that those tracks to partnership are critically important, I think that should help inform us on how we should be thinking about that career pathing as we're hiring those individuals.
Yeah, yeah, that's good. Thanks for sharing that. It's helpful because you would assume based on what you hear or maybe what older generations are saying around this next gen coming up is that work from home, work in your sweatpants or be able to make as much money as possible. That just sometimes can just be a poor assumption. Sometimes you just got to ask. Um, so one of the things I've heard you say a couple of times through Concurrent is that there's support systems and that it's not just that advisor out there kind of forging their way. And you talked a little bit about some of the structure for retaining that G2 and some of that succession planning. But I'd kind of would like to dig in a little bit of what does it look like when an advisor decides to join Concurrent? So in the lane of integrator or aggregator in our succession space, talk about how Concurrent fits into those molds.
Yeah, I would say probably more aggregator than integrator. Our belief on the future of this space and really I think our this belief is what, has kind of fueled the structure that we've created is that, advisors are looking for independence, right? Not just independence in business model, not just the ability to control a P&L, but really independence in terms of objectivity of advice, right? I think advisors want and we believe in this concept of advisor centricity, right? Which is clients are going to gravitate towards advisors because they're like-minded, they share their core values, they're best equipped to serve their niche. So we feel like we'd be doing a disservice to try to disintermediate our advisor from the client, right? And really we should be putting their core strengths up on a pedestal and supporting that. That's why a lot of our marketing and branding resources are built around helping our advisors build their own brands. And so, you look at our website, it's a little bit like a NASCAR jacket. There's like 50 or 60 different brands there, but that's by design, right? Because those advisors are operating firms that are operating in different geographies across different client demographics. Just in the last week, I was with one of our firms in Kingsport, Tennessee, right, who are typically serving, mass affluent clients, right? I think the higher end of their account sizes are 3 to 4 million. And that's one example. Then, the day before I was in Philadelphia, Pennsylvania with one of our teams that came from a wirehouse background that's dealing in the high net worth, ultra high net worth space, and a 10 to $25 million client is commonplace. So, again, those firms and how they're positioning themselves are materially different, but that's okay, right? Then it should be that way. So from our perspective, I think advisor centricity has been a core tenet of what we're doing in trying to provide really this haven for entrepreneurs. And that's how we view our model. Um, at the end of the day, we're not muddled in terms of our mindset. We want to go affiliate entrepreneurial advisors. We want to empower them through the platform that we can bring alongside of them. We want to create this environment where they can operate with objectivity and independence, where they can differentiate themselves, but where they're aligned with like-minded entrepreneurs around the country. And that's where that collaboration comes into play, and the idea that iron sharpens iron. And so, with that philosophy, then you start to look at kind of what our service offering is and what that support structure looks like, right? At the
Mhm.
end of the day, we've got to do the table stake stuff super well. So when you think of like compliance, custodial operations, technology and cybersecurity, billing, right? All the core finance functions, we've got to do those things really well. Those have to be bulletproof. And then as we kind of continue to go up the value stack, right? The next layer, when you think about any wealth management practice, you know, you've got investments, you've got planning, you've got client service, and there's front stage and backstage elements to each of those different components. We want to own the backstage because we believe the advisor differentiates themselves on the front stage. So like a quick example, like within our investment platform, the conversation we're not having is, hey, come use our models. This is why they perform better, right? The conversation we're having is, let us come alongside of you as your OCIO. Let us design the investment program for your firm. Let us facilitate your investment committee meetings and sit on that committee. Let us handle the back end research and due diligence, and let us handle the implementation right when decisions are made. And we can execute that on a very open architecture platform. So that's just how we think about things, right? And so we know that we want to cast a wide net. We're attracting advisors from all different channels, whether wirehouse or independent broker dealer or existing RIAs. I think that we've been able to provide a great, again, haven for entrepreneurs, a great solution set to support them as they look to take the next step in their business. And
Yeah.
I would say the other thing that we're really focused on heavily is, firms that are looking to transition from, I'll call it like practice to enterprise. And that can be from an organic growth standpoint, like a lot of what Tyson mentioned around creating kind of specialized roles within the firm. One, not only to solve for succession, but two, we think that can help create capacity to allow your rainmakers to go out and run and to drive growth, or firms that are looking to grow inorganically through acquisition, through recruiting. That's another, I would say, specialty of ours, is being able to come alongside of firms with that mentality and being able to bring the consulting expertise, the platform, right, and the capital to help them go and execute on that potential growth strategy.
So you talk a little bit about, you said earlier about having a minority stake in some versus acquiring the whole thing. Talk about, because that's unique to some firms like Concurrent. Talk about what, is it, do I have to sell everything or can I sell a part? How does that work?
Yeah. Yeah, and goes back to like devil's in the details, right? Because there's a lot of what I'll call full acquisitions parading as minority investments, right? And so forth. So when you think about our model, our mindset is we never want to turn an entrepreneur into an employee. So when we're talking about taking a minority equity stake in a business, again, it's a true minority equity stake, right? Where we're not buying 100% of the goodwill and leaving them with a portion of the cash flow. We are truly taking a minority interest in their firm. We're investing in them as an entrepreneur, right? Because we believe that with our support and resources that we can help them grow faster than they might otherwise be able to on their own. And when I talk to an advisor who's considering participating in our partnership model and taking on the cash and equity for that equity stake that we're buying, that's usually what I lead with, right? Is like, hey, the only time it makes sense for you to sell equity is if you believe that in doing so, you're going to get to point B faster than you otherwise could in
Mm.
some way,
Yeah.
right? And so that's why it would make sense to take that dilution. So from our perspective, it's a true minority equity stake. As you think about our model as well, I'm a big believer that capital informs strategy. When you look at our capital backing, we have a minority investor ourselves called Merchant Wealth Partners. And, one of the reasons we chose Merchant back in 2020, 2021, when we originally forged that partnership, was one, again, they share that same philosophy of not wanting to turn entrepreneurs into employees. They take minority investments primarily themselves. And so that was attractive for me. We were in our early stage of growth. We didn't want the tail to necessarily wag the dog. And so again, finding a firm that was willing to sit in that seat and buy into us as an organization and us as
Mhm.
people was highly attractive. But the second main driver there was that their capital backing is permanent, right? And
Mm.
so you see far too often, most of the money coming to the space is private equity, and it's raised through private equity funds, which means inherently there's a shot clock on the money. And I think what we're going to see over the next couple of years is, hey, a lot of those larger roll-ups that have been out there acquiring that are private equity backed, the life cycle of those funds is coming up. And so you're going to all of a
Yeah.
sudden start to see recaps. You're going to start to see transitions. And I think you've seen a lot of private equity firms now do like continuation vehicles and are looking at secondaries to be able to stay invested. But I think that adds an interesting dynamic for us because the capital behind us is long term, right? Has long duration. We don't have that shot clock on the money. So it allows us to take a long-term perspective from a growth standpoint. So what we've really done is we've taken those same principles that we looked for when we were seeking out a capital partner, and we've just applied those to the model that we're now delivering. And so, from our perspective, coming in as true minority, again, being able to invest in these businesses, and we're seeing a variety of different uses for the capital, right? I think you've got a subset of firms that just want to de-risk. They've looked at some of these larger roll-up opportunities. They didn't want to throw in the towel, right? They didn't want to sell all of their business and submit to that level of control, but the multiples were attractive and it made sense for them to take some chips off the table. Great. We can facilitate accessing liquidity, right? That's one use case. Two, that facilitation of internal succession that we talked about, that's a phenomenal use case, right? Because we can come alongside that G2 advisor, essentially co-invest with them to buy a part or all of that practice, where they're still maintaining full operational control and acquiring the majority of that business, but we're able to effectively subsidize it, right, by coming in at a higher multiple alongside of them and then providing the debt financing to help them get it done. That's a great use case. And I would say the last one, which we've really seen an uptake on, especially for our firms that are interested in inorganic growth, is leveraging us as an equity partner to help fund that next phase of growth. Because if they're doing multiple acquisitions, they start to hit aggregate exposure limits with their lenders from a debt standpoint. At that point, they've got to use both sides of the balance sheet, and we can come in and ultimately invest in those businesses, bring equity capital to the table, and use a great balance of debt and equity to help them self-perpetuate that growth strategy. So a lot of different ways we can wield it, but I think at the end of the day, the core and why it's been attractive to firms is that, again, we're coming in as true minority, and at the end of the day, we're really betting on them and their growth model and what they're doing. And from that point, I think that's what's made us successful, and it's been very consistent with this mindset of creating, again, a haven for entrepreneurs.
So, so is Concurrent a solution for somebody who just wants to sell the whole business?
So I would say that what you will not see us do is go out and buy full practices for succession purposes. Now, we might co-invest, right? So like one of our firms within our ecosystem um, can absolutely be a succession solution for a firm. And our preferred position there is to come alongside of them with capital. In all likelihood, we're already a minority investor in that business. So we can contribute our share of equity capital into the deal, coordinate debt financing, help them close on that transaction, give them the scalability because of the platform we've already put in place. And so our preferred position is to be that co-investor. So when I say no, it's not at the concurrent level. Like we're not in the business of serving clients. We're in the business of serving advisors. But in a situation where we came across one of those opportunities, we'd work with one of our firms in that region that could be a good fit to ultimately take on those clients and step in that co-investor seat.
There you go.
That's great. Well, and honestly, Nate, that's kind of that's a little bit of a rarity in this space because you're talking about the value of independence and succession, all in the same lane. Because I think right now, for those of you listening, you're thinking that it's always one or the other. that's not being brought together in a way that makes sense, and that giving the advisor, the ability to kind of make some of those decisions and not lose all of their autonomy, because a lot of them still have a lot of skin in the game and a lot of energy in the tank, and they wanna be able to maintain their independence, but they know that the right thing to do is to actually have a succession plan in place.
Yeah. And I think one of the other advantages of our model, so in addition to getting cash and equity proceeds in the initial transaction for that small minority stake, every one of our teams that chooses to partner with us in this capacity also has tag along rights in any future monetization, recapitalization that we have as an organization.
Oh,
So
wow.
essentially, it gives them a seat at our table, right? As we think about our future capital formation, right? And how we're thinking about monetizing the collective business. And with that, I think when you think about what drives valuation in our space, it's scale, diversity of revenue, alignment, growth, right? Those are the four key drivers of valuation. So we're able to bring, I'll call it that, enterprise level scale because we've got this diverse group of advisors. We've got about 76 firms that currently leverage the platform today that are IARs of Concurrent. We also have 5 third-party RIAs that we have minority investments in that are not sitting on the platform, but that we are invested in and that are partners in our organization. And so when you start to think about, call it 81 different unique businesses around the country that are carrying a common currency, operating across different client segments and geographies and so forth, you have a high degree of diversification, right?
Yeah,
So
you
now we've
do.
got, scale, right? We've got diversity of revenue, we've got alignment through shared ownership, and what that creates is multiple expansion. So that
Mm,
tag along concept for us gives all of our firms an option, but not an obligation, that in any future recap or monetization events for Concurrent, that they can come alongside of us and participate to the extent that they want to. And really what we're trying to do there is create this opportunity for continuous liquidity that hasn't historically existed, right? Before, historically, you've had to just, if you wanted liquidity, you had to sell your business. I think what's unique about our model is this ability to come to the window, access liquidity if and where you want it. And we've had firms now that have come 2 or 3 times for different reasons, right? To be able to tap liquidity at rising multiples in their business, and we want to continue that trajectory going forward. So I think that's another unique hallmark that, Kim, to your point, you're kind of fusing a succession solution with independence and kind of decoupling the economic outcome from the person in a really intelligent way that allows them to get the best of both worlds, right? A great economic outcome, but also ensure that it's the right end solution for their client from a person perspective.
yeah. Yeah, that's very true. So thank you for that. I think it's helpful to know that there's a lot of variety out in this space, and for you, those of you listening, that it's not just one way. There's always going to be something out there that might fit what you're really looking for. So I think something I want to kind of bring you into the conversation around is in Tyson's book, The Total Succession. We talk about on the podcast all the time is the SPACE framework, and it breaks down into 5 steps. It's an acronym because Tyson loves a good acronym. It's see, prepare, act, commit, and exit. And Tyson, you can share a little bit more about that. And then Nate, I'd love to kind of get your perspective on how those ideas kind of show up in your world.
Yeah. So, and you had kind of said it earlier when you were doing the consulting work and talking about the 10-year time frame. What you were asking them is, can you see what your future is, right? And that's but part of the space framework is just, first of all, will you take the space in your calendar, your time, your work, make space, be quiet, get away, think. But that whole C part is do you see yourself exiting? Do you see yourself being called to do something else? What are your family members and those that love you that have been waiting all these decades to do something different? What do they see you doing?
Sure.
And when you can crystallize a little bit of what that vision is or what you see in yourself, then what do you need to prepare to make that a reality? What do you need to then act on from that list of preparedness? Then what do you need to commit to? Because there's some things you need to commit to not doing to then ultimately exit. And so that framework is just it's kind of a mental checklist almost. Um,
Yep.
but how do you see that apply with
Yeah.
advisors when it comes to succession?
I love the framework. One thing we talk a lot about internally is doing R&D on different ideas. And
Mhm.
and this one, we might have to R&D this one. It stands for rip off and duplicate. But no, I love the space framework. It's cool. And I always say that, like, succession is a process, not an event. right? So it's almost like at the end of that, that exit is the kind of the outcome, right? But what you've done in going through those steps, I think is hugely important. And look, you see that as someone's preparing for succession. You also see that with advisors that are considering a potential move, right? Like when I think about, an advisor that's considering a move, one, there's got to be enough pain in their current situation to warrant a change. But then two, they've really got to go through the educational process to understand what the landscape looks like. Because if you look at, you've got kind of I'll call it bank and wirehouse type environment that then evolves into the IBD environment, then into the RIA space. And in a lot of cases, there's firms that are in the RIA space that are more captive than the most captive bank environments, right? So it's like really understanding the landscape and what that looks like, I think applies to both advisors in transition as well as advisors that are looking at succession. And
Mhm.
so I think that's hugely critical is to spend the time. And I love what you guys are doing with the book because I think being able to give advisors a resource where they can really learn and understand these different models, right? I think is important because like you said, there's a ton of different options out there. But being methodical in going through those steps is critically important because the sooner you start doing it, right, the more options and the more flexibility you're ultimately going to have. So I think the more that you guys can evangelize the space methodology and get in front of advisors as soon as possible, especially with, whatever the average age is today, it seems like it's always getting older, but
Yeah.
I do think we have a limited time to evangelize the space process.
Yeah.
So I think it's spot on. And really the key is be intentional and be methodical and give yourself the time to be able to actually go through those steps because that's what's going to guarantee the best outcome for your clients, for your staff, and then ultimately for you and your family.
Yeah. So what if I could repeat what you said is that at the beginning of it is if you don't actually start to actually make that an initiative, you're going to struggle all the way through. You actually need to begin at the beginning and prioritize it. And it kind of circles back to the conversation points earlier. If you're not making the time to do it, the time you have to make the decision really limits your options for your future. And so, thank you. We'll happily let you help us evangelize that conversation because it's helpful, and we really want to make sure advisors are setting themselves up for success because they've built a great business and they've built something that's worth handing off well or selling well, and they just really need to put some time to that.
Absolutely.
So one thing that I think might help because people kind of need a little bit of that framework to kind of like wrap their heads around because they might not really see themselves in that and taking on that framework all on their own, but something that they kind of need to do is actually take some steps. And I think what would be helpful after kind of hearing that framework, how do you see Concurrent helping advisors move through that framework?
Yeah. I do think there's an element of, all right, like if you want to have the widest solution set available to you, right? That solution set exists in the RIA space. So step one is if you're, even if you're saying, hey, I'm 10 or 15 years out, right? Succession doesn't need to be top of mind. I think you do need to be considering kind of where you're sitting today and in that seat, what options are available to you, right? And if those are satisfactory. And the answer might be yes, but I think at least being intentional at that stage of the process will be important. From there, especially with the teams that are already sitting on our platform that we're working with, it goes back to understanding the who, right? Who's going to ultimately step in? Do you already have that person in place? If not, do we have to go find that person? Is it going to be done by committee? Is it going to be done through some type of merger? Because I think that's another step here of like, okay, is this something, do I want to spend the time to develop somebody internally? Do I have the wherewithal to do it? Or would my clients be better served by aligning with another firm that might have that infrastructure and that team in place? So I think step two is kind of in helping firms identify that. So we
Great.
go deep from a consulting standpoint. We've got a really strong, what we call our practice synergies team, which is focused on practice management coaching and business consulting. And we take our firms through a practice assessment so that they can understand, areas of opportunity to work on within their business and in ways that we might be able to help them with that. But usually that's a great first step in thinking about succession planning because they might be able to identify gaps in their current process with clients. And from there, that's where I think that could be a great opportunity if you're adding talent for them to step into that role. And that could be a great entry point. So the who
That's
I think is the
great.
next part of it. Finally, let's say they get to the point where they're ready to start to either transition ownership, whether in whole or in part. That's another area that's area of expertise of ours, which is, how are we going out and financing that element of it, right? Are we coming alongside with equity and debt financing to help facilitate it? Is it straight debt financing? Is it seller carried? What types of contingencies need to be in place, right? So really being able to operate in that consulting capacity to help them construct a deal that's going to meet their needs from a transition timeline
No.
standpoint, from a liquidity standpoint, and so forth.
Oh, that's great, Nate. Thank you. That's really helpful. There's a lot of really great tools that you guys are putting in place to really help advisors think about their succession and independence in a really intentional way. And it's definitely a need and a gap in this space. This has been hugely helpful. And I just want to thank you for joining us today and just sharing this perspective because I think it's much needed in the succession space to know that there's a great option out there. So thank you so much for being here.
Yeah, thank you guys. It's been a lot of fun. And if anyone wants to check out the NASCAR jacket, right, the website will be a great place to start.
We'll be back soon with more conversations like this.
These conversations are designed to support your next move, however close or far it may be. Tap subscribe and let each episode guide you closer to a confident, well-planned exit. I've wrestled with these things myself, and that's exactly why I created something to help you do it with less stress and more direction. My book, Total Succession, is now available on Amazon. Inside, I break the process down into 5 clear steps to help you exit on your terms with confidence, full compensation, and your client's best interests at heart. You can also visit totalsuccession.com/podcast to download a free starter guide that walks you through my SPACE framework: see, prepare, act, commit, exit. Remember, you only exit your business once. Create the space to do it well. Thanks for listening. Until next time.